Hello, this is Manesh Patel with ValeTalks. Today's session, we're going to talk about liquidity, retail versus institutional perspective. As you know, we've been doing these ValeTalk sessions. We've been doing various different topics every week, and we've had a great time. Ryan's typically our host. Unfortunately, he's sick today, so Ryan, we shout out to you. Hopefully, you get better. Today, I'm going to be hosting and have Dennis online with me. How you doing, Dennis?
I'm doing great. How are you doing, Manesh?
I'm good. So today's topic, we're talking about liquidity. This is probably the
Yeah.
hardest topic to talk about, especially retail versus institutional. Especially it's hard to relate with charts. I'm a technician. I think you're a technician a lot too. So we're going to try to relate this to charts too. But before we begin, let's talk about what liquidity is. Okay. A lot of people think liquidity is volume, especially retail perspectives. However, it's not. It's really the liquidity is the ability to buy or sell a particular instrument is that can significantly affect the price. So how can you tell liquidity? The best way to tell if liquidity is there or not is through the spreads. If the spreads are big, that means it's not too liquid. If the spreads are tight, then it means there's a lot of liquidity there. But it really affects you because it could affect you on the price you get in. And that really makes a difference on your reward risk. So liquidity is pretty much how you're going to affect the price. It's not really volume at all. Do you agree with that definition, Dennis? What do you think?
I'm telling you, that definition. Basically, a lot of retail traders don't get it like that, by the way. We believe
Yep.
that most of us, when we are starting out, you usually believe liquidity has everything to do with volume. So we are looking at our volume bars, we are looking at our charts, thinking about volume, but clearly, it's not. Clearly, it's not.
Yeah.
And I wonder what's the reason why? Why do most retail traders usually think liquidity is about the volume? Because there is that misconception out there, even up to this particular point. When you watch a lot of educational videos on YouTube, everyone who is talking about liquidity, they're usually referring to volume. So
Yeah.
it's quite interesting, yeah.
Yeah, and
Mm-hmm.
it's a big misconception across the board. I think it comes a lot with the stock markets. A lot of people dealing with stock markets and volume makes a big difference. But there's a huge difference between stock markets and then when you start dealing with currencies and stuff like that, in that stock markets are more of a centralized market. Currencies are decentralized. So the central banks and the institutions and all that is really where all the volume's coming in. And at some point, they're going to do things differently, right? And if you look at an institutional perspective compared to retail, an institutional may be buying millions of orders for Euro USD, right? Whereas institution is going to be buying small. When an institution buys, they can't just send out their orders just like that in the market. If they're buying Euro USD, they have to slowly buy it. Because if they send out the big massive order, right, they're going to change the price. And at that point, they're going to have huge slippage. So if I'm trying to buy here, so if you look at the currency price right now for Euro USD, if I right now it's 1.1642. If I sit there and send a million lots here, at that point, I'm not going to be able to buy it at 1.647. I'll probably some I'll buy there, some will be 50 points higher, some will maybe 100 points higher. So really what happens is if I get a huge order out there, as most institutions do, they're going to change the price. If they change the price, they're not going to get a good reward risk at all. And that's a major problem for institutions. So if they see something that there's not enough like sellers here when they're trying to buy a huge order, they're going to slowly accumulate or they're going to move on to something different. So that's a different perspective compared to a retail guy. A retail guy is going to look at a chart and say, okay, I want to buy here, one mini lot. It could be one lot and stuff like that. They're really not going to change the price with their orders, but an institution can change the price of a chart with their orders. And that's a big difference there. So the volume really doesn't matter what you're buying right now, but the orders out there really matters. Where are the sellers here? If I'm looking to buy, where are the sellers and how many positions do they have at those different price levels? That's really what's going to make a big difference and compared to the volume I'm buying right now. Does that make sense, Dennis?
Yeah, and like what type of orders, basically market orders, do institutional players usually use in the market? I think you can elaborate more on that so that guys can understand the importance of knowing the type of orders that are used, limit orders, sell stops, buy stops, etc.
You're really not going to get a lot of institutions that are going to use buy stop orders. They're not really doing breakout trades. A lot of them are going to be doing
Mm.
pullback trades and slowly buying. So here, for example, you could look at the
Mm-hmm.
Euro USD. I marked up the lines, the top of the consolidation pattern here, right here, which is at 1.1830, and the bottom pretty much here is at 1.453. So you're going to see that institutions are going to know the buy zone levels and the sell zone levels. And if they feel like this is still bullish, what they're going to do is as soon as it gets here, they're going to have an order out there. They're not going to wait for a breakout or anything like that at all, right? So they're going to be accumulating in different aspects of everything. And remember, if you're looking to buy, there's someone always selling. And that's the key thing to understand all the time. And that's what most retail people don't understand is that institutions are going to have their orders out there. They know exactly where to buy. They have the orders out there and they have a certain amount of orders out there. And they could see the order flow and the orders out there to know where people are buying, where people are selling. So they know exactly if I'm looking to buy 10 lots at this level, they see that, right? They see, so if they're looking to sell there, they know there's 10 lots they could take on. So they always look at what the levels are, what orders are there, how many orders are there, so the order size, everything there, and then go from there. But they're accumulating positions. They're not just getting in. They're slowly getting in so they don't affect the price. And that's a big difference. So they're more of a pullback trader than a breakout trader, if you think about it.
So, so that puts breakout trading strategies at risk.
Well, I mean, if you look
What?
here,
Yeah.
if you look
Uh-huh.
here, this is a perfect example. This resistance level here held. Look how it held here, right?
Yeah.
So the people could have placed an order here. They said so. A lot of people could have placed a buy stop order here for breakout, and then look what happened. If the institution saw there was a lot of orders there, right, and they feel like this is going to hold, what they're going to do is they're going to while these people are buying, these buy stop orders are buying, they're selling, right? And that's why you don't
Yeah.
have the follow through. So you could see from here that they force this up, look like it's a breakout, and then look reverse. That's telling you the institutions are having this level here, and they're basically selling at that level right there. And then you could see all these fake breakouts here. This broke out this level here, but the bar is bearish. Then over here, you came back into the zone. Then you came above the zone. Now you're back into the zone. So you could see there's games being played here. And then you could see here, institutions are still selling. If they were buying, they would be slowly buying to a point this would be going up. They're not. So you could see all these freight breakouts and stuff like that. Same here. Look what happened here. It looked like you broke out. Then look what it did. Came back in. So you could see right now, basically, these are the zone the institutions are playing. And if you look at the zone here, this is around what? About 250 pips. It's about 300 pips or so. It's a 300
Yeah.
pip range right now, right? So it's not really where institutions are playing Euro USD big at all. Does that make sense?
Yeah, it totally makes sense. And the unfortunate part is that as a retail trader, sometimes you get to be trapped.
Yes,
In you see, like,
liquidity
yeah,
traps.
you basically you're in a liquidity trap, and it happens a lot. By the time someone wraps their head around the fact that, hey, I need to change how I think in terms of approaching the market, in terms of the perspective, having the perspective of the institutions, it really takes a lot of time, a lot of psychological work to be done because You keep blowing accounts. Can you imagine how many accounts have been blown in these
Yeah.
particular areas where we have a trap? Imagine this is basically this is how an account dies in this kind of environment. All this trap to at the resistance levels, at the support levels. So when institutions are looking at price, they don't just see support and resistance. They see areas where they can dump orders and get their orders absorbed very quickly, depending on which side of the market they want to, take. Maybe they want to buy, maybe they want to sell. So it's basically about looking at price action from the perspective of where do if I'm a big buyer, for example, where are the sellers? If I want to place a big sell order, where are the
Yep.
buyers? So from that kind of perspective, right?
Yeah, and if you sum it down, right, you could look at 4
Yeah.
points for each side. So the retail perspective pretty much looks at indicators, technical patterns, news releases, volume spikes. That's typically the retail perspective, okay? The institutional perspective looks at order flow. They look at stop clusters, where a lot of stops are, like buy stops, sell stops, and stuff like that. They look at market depth, and then they look at liquidity pools. So they're looking at more where the orders are compared to more of the chart perspective and stuff like that. That's a huge difference there. And notice for the institutional side, I didn't say volume, right? Because if you think about it, institutions are slowly going to buy. So do they really want you to see their volume? No. If
No,
you see their volume,
no.
you're going to change the price to a point they can't get the price they want. So they're not going to show you their what they're doing with volume at all. And that's why they don't look at that. They look at the order flow, which is huge, right? And then they look at like where all the stops are, all the stops the clusters are, and then go from there. And then they look at liquidity pools, where is everything at? So those are the things they look at, whereas us as retail perspective, we look at indicators, technical patterns, news releases, especially news releases. A lot of retail people get into news releases, and then volatility spikes, volume spikes, and stuff like that. They'll give you biased. I mean, let me just put it this way. I probably don't ever, I gave up looking at volume back in 2008. Since then, I've never
Mhm.
looked at volume for stocks, currencies, futures, crypto, nothing. I've given that up completely. And the reason why is when I went into the institutional world, I saw that volume really does not matter. And you could really get biased with volume, whereas, and really affect you in your trading.
And for example, like back when you are at the institutional desk, did you guys have some sort of special, well, let me not call them special, but powerful tools, for monitoring this
Yeah.
order flow?
Yeah, you do. And then let's say like,
Mm-hmm.
we did both stocks, currencies, and everything. And if I had a huge order to place, I typically, like especially on stocks, you look at dark pools and stuff like that, right? Because you don't want to change
Mm.
the price at all. So if I want to buy at a certain level, I need to buy to a point I'm not going to affect the price. And that's the thing institutions are very keen on doing. They call it slippage. So if I'm looking to buy something at
Yeah.
$100 and I buy it at 101, that's $1 slippage, and that's not good at all.
Yeah,
So you need
yeah.
to make sure
If
you
you're
do
dealing with
that.
huge volumes, if you're dealing with a huge
Yeah,
order, that is not good. That slippage, it's a killer.
yeah.
and
So
and
that's
Manesh,
why you
going
have to
back,
look at the order flow.
yeah,
That's why
going
you
back to
have to
the
look at the
some
order flow. Right?
there is something you said. There is something you said. You said dark pools. You mentioned dark pools. What are these dark pools? Need to define this for guys.
It's where institutions are trading
Mm-hmm.
within themselves. Like Goldman Sachs
Okay.
will trade with others and stuff like that. You see that more on a
Okay.
centralized market. It's more stock markets and stuff like that. On the currency side, you really don't get that much because, it's controlled more by the central banks and stuff like that, the big institutions and so forth. So if you really look at the hierarchy of the market participants, in the currency market, for example, you have central banks are first, then you have commercial banks are next, hedge funds, asset managers, corporations, and retail. So that's how the hierarchy of volume of the trading works. And so the central banks have the biggest influence. Second is the commercial banks. And if you look at the retail perspective, they're at the very end and they're pretty much the sixth in line compared to everyone else. So, they're not, the chances of a retail trader influencing the price is very low compared to central banks and so forth. So, because they're buying more at a higher volume than anyone else.
So retail traders,
So,
we're just looking to enjoy the ride. We're not looking to move the market.
well, that's what you should be doing is enjoying the ride, right?
Mhm.
You should be going against it because that's where the liquidity is. And if you look at the currency market and you break it down, the sessions that really make a difference, believe it or not, is the London session has the highest volatility. New York session has the highest volatility too. Okay, so those are the two ones that have the highest volatility, highest liquidity, not volatility. So those are the two
Yeah.
sessions where you have the most liquidity out there, and those are actually, believe it or not, you could see a lot of things and patterns develop in those two sessions. Does that make sense?
Mm. Yeah,
So
yeah,
I
makes
don't really
sense.
look at
Yeah.
the Asian session to develop a pattern at all, because if you look at the
Hmm.
Asian session, it doesn't have that much liquidity. So whatever happens at that, it typically doesn't start a trend there at all. What typically between when the New York and London sessions overlap, that's typically where you have the most liquidity there, and you could see the patterns on a chart evolving there. So if you're a retail trader and you want to go with liquidity, you could kind of look between the London session and the New York session and see what's going on. And at that point, they'll give you a really good idea of what is going to happen. You really can't judge it based on the Asian session at all because there's not much liquidity there.
So yeah, so during the London or the New York trading session, it's really a prime time for identifying market structure. By structure here I mean a trend, catching a very
Yep.
nice trend, a trend starting to develop during these sessions. For example, you can have a trend that starts developing during the London session and then later on extend all the way to the New York session. You can have a very good day. But Manesh, this doesn't happen every day, right?
No.
Mhm.
Sorry. No, because remember, they're
Yeah.
accumulating for long term, right?
Okay.
Institutions, central banks, and everything really don't want to sit there, go in and out of this market over and over. They're looking at slowly accumulating a position that they're looking to hold long term. And most of their positions are going to be 3 months or longer. So that's what they're looking at doing. They're not looking at day trading or swing trading or anything like that as us retail traders do. They're pretty much looking to hold long-term positions and looking for it to go up, average 300, 500 pips or so forth. And that's what they're looking at. Remember, they got a huge amount of money, so they got a huge number of volume that they're going to be trading. So they can't look for 20 pip movements and be happy because you could have a 20 pip slippage in just buying those positions or selling those positions. So they have to have that instant move 300, 500, 600 pips or more in order for them to really make some good money.
And back at the institution, did you guys used to like day trade? Is it a
Well,
common thing? Yeah.
so it just depends on the perspective of the institution, right? Majority of the money
Okay.
is pretty much long term, and they may have a small division for more swing trading and day trading and stuff like that. But majority of
Mm,
institutions are set up for long term positions because that's uh, more logical based on what the perspective of the institution is, right? Because if you think about it, if you're managing $50 million, for example, right, you're not going to, if you're trying to buy these positions in your day trading and day trading range is 20 pips and you got that much volume, you could get a 5 pip, 10 pip slippage, and the average movement during a day trading session could be 20 pips. You're not going to make much money. The reward risk is not good, right? So, so on average, most currencies move, with volatile, even with volatility, they're going to move what in a day, 100 pips, 150 pips, right? And if I'm
Yeah,
buying
yeah,
100 lots of Euro USD and I am buying it with huge volume and I get a 10 pip slippage, now guess what? There's only a limited amount of profit I can make. So that's really
mhm,
not the way I want to do it. And remember, when they're buying a volume, it takes time to accumulate those positions. So it's not really inducive for day trading at all, right? They may have another
yeah,
division that's there for day trading, but with smaller amount of money allocated and stuff like that, right? So they could do it
yeah,
that way.
yeah.
But majority of institutions, hedge funds, and all that are long term. They're not short term at all.
They're not scalping.
No, they're definitely not scalping. Now, they may have robots, they may have like algorithms, right? That are
Yeah.
there.
Uh-huh.
So we had algorithms that we created institutional that were there that were more scalping there, but those more are machine based than a person based.
Yeah. Can a person manage to scalp effectively compared to machine?
That's
I usually have
milliseconds
that
trades.
bias. I usually have that bias. So a bias that when it comes to day trading, it's okay as an individual. You can try, but really day trading, I believe it's for machines. It's for machines. You rather one would rather design a system, create an algorithm, an automated system, and then let it do the trading, let it do the short term trading. But if I were to try doing day trading, I'll blow up in less than a week. I mean, I can imagine the stress, the
Yeah.
anxiety, I mean, it's crazy. It's crazy. I can't think like a robot. I'm a human being. I'm very emotional, of course. So I would say,
Yeah, yeah.
maybe there are people who they trade very, very, very well, but even institutions, when it comes to day trading, they're still using machines, right?
They are, but I mean, as a day trader,
Mm-hmm.
you can make money as long as you're are disciplined and follow your trading plan, right? And take your emotions out. And if you're looking to day trade all day long, then you're going to be tired and you're going to have a tendency of making mistakes, which is not good, right? If you day trade for
Yeah,
an hour, 2 hours, or 3 hours, like during the transition between London and New York, and you're day trading currencies, that's a short period, and you have a higher probability of success being a good day trader compared to doing it all day long, right? So you have
yeah,
chances there, but the thing I suggest to retail traders is don't day trade, at least swing trade. Swing trading, you have a higher probability because you're on a higher time frame. You're looking for more price action movements. It gives you ability to cover more volatility swings that day traders go through in the machine. So if you're trading 1 hour or above, you have a higher probability of success becoming a real
yeah.
full-time trader compared to day trading.
Oh, Manesh, by the way, there is that chart you are looking at, Euro versus
Uh-huh.
the Kiwi.
Yeah.
Can you do a breakdown of that chart from an institutional perspective?
Yeah.
Yeah, please.
Yeah. So this is a trade here that we're in. You could see here that it was going up, up, up. You could see here there's a big bar here. And what we look for is institutions look at highs and lows of bars a lot. Okay. So they don't do sophisticated technical analysis. Most of them don't. They look at highs and lows and just keep it simple. And here you could see here, you broke this high right there, but it was still a bullish bar. Let me zoom in. It was here, right? Then over here, you broke this high right there, and then you went down and you broke this low here and you closed the real bearish bar with volatility. So you could see here now that this buying has a high probability of being over. Does that make sense? Right? So now
So
the
that
question
is,
is, yeah, so you could see this was
oh,
going up, up, up. So you could see institutions were buying because that's the only way
yeah,
this thing could go up this much, right? And if you look at the
yeah.
price movement that this thing's gone up, you've gone from 1.8900 all the way up here to 2.0500. That's a huge price movement, okay? At some point, these institutions are going to say, okay, we're done with this one. And now they're like, okay, we need to start taking profits. So I look for big trends like this, and then I start looking for signs where they're looking to take profits. Okay? Because
Okay.
when they're looking to take profits, most likely they could sit there and just exit out the position completely, or they could go thinking it's going to reverse, right? So that's what I'm looking for. So here's the first sign I'm seeing that these institutions now are profit taking here. And you could see it here. You could see there's some buying that goes on and then basically it got brought down. So they're selling when the retail are buying here. Here, you could see here, it broke the high again here and then closed below it right there. Okay, I call this a fake bar. And you could see here that basically they're selling out. Then all of a sudden here, look what happens. Big positions being dumped.
Mhm.
Now you're accumulating. You see that? And if you look at where this was being dumped, this here started this whole thing right there. That is a key level here. So they started this whole movement of getting rid of positions here, and then look what we did. We came here, we broke this previous bar high right here. And remember, this is a weekly chart. And then look what we did. We went bearish. So you could see they're
Mhm.
still trying to sell. So over here is where we enter the positions here to sell. And then we look for it to retest this low here, which it did. Now this is a critical range for us here. So we did some profit taking
Mhm.
now here at this level here. And now we're waiting to see what's going to happen. If this breaks this weekly low, at that point,
Okay.
this is going to have a high probability to retrace this whole thing here. If it holds, then this could be the new consolidation pattern. So this is at a very critical stage right now on what it wants to do.
So that's last week's low. It's a very critical low to
Yep.
keep an eye on, basically,
Yeah. If
right?
you break this weekly
Ah,
low right here from last week, you got a high probability
yeah.
you're going to come back to the base here of where this was being
Mm-hmm.
basically bought here. And you could see if you zoom out here, this has been going up for a while, right? This has been going up for a very long time. You could see that right there. And if I go to the monthly view, you could see here that it's been going up for a very long time. Do you see that? And here you could
Yeah.
see if you go to the monthly view, you could see this was consolidating here. And then all of a sudden you broke out here, and then look what it did. It took off, didn't it?
It took off. Yeah. Just took off.
Yeah. So you could see there was a battle here, and you could see institutions were accumulating at this point, and then finally it broke out.
Mhm.
Do you see that?
And yeah, yeah. And the institutions, they accumulate silently
Yes, that's
before
the
the break.
key.
Mm.
They're not going to
Mm-hmm.
do it with huge volumes. So if you put on the
Mm.
volume indicator here and you see a big volatility spike, that's not retail. I'm
It-
sorry, that's not
it's
institutional.
yeah.
It's retail.
Mm.
So
Mm.
actually, you could go counter trend and look for volatility spikes and see what retail are doing. And at that point, you could think opposite, contrary, and see eventually when
Yeah.
it could go the other way. So some algorithms, believe it or not, are built on volume, where if they see volume price go up with volume, huge amount of volume, those algorithms are actually thinking bearish because they
And
know it's more retail.
yeah, it's more retail. It totally makes sense. And this reminds me of something called retail sentiment data. I know you're familiar with it, right?
Yep,
Retail sentiment data. So institutions look at retail sentiment data, I would say maybe, and then interpret it in a contrarian fashion. I- you know?
yep. And you could, I
Yeah,
mean,
for
you
example.
go count
Mm-hmm,
all
mm-hmm,
that, right? You look for all that
Yeah.
information, right? Especially with
Yes.
social media now, a lot of people are looking at social media and seeing what's talked about the most. So if most
Yeah.
people are talking about Euro, New Zealand, you know that that's pretty much retail. So you could think that, okay, when institutions see that, if institutions see that retail's talking about one particular instant a lot and they're in it, they were like, maybe it's time to get out, right? Because at that point, they're going to get a big push with retail, so they're going to get good
Yeah.
profits, but they're thinking of getting out at that point because it's easier for them to get out when retail people are coming in because there's orders there. If retail people weren't coming in, it's hard for them to get out of a position.
Yeah. And the beautiful thing about this is that this kind of approach or thinking, from an institutional perspective, can be applied to any asset that actively trades, right?
Yep.
Any asset,
Yep.
as long as you have access to, the chart, I suppose, but any other asset. But a lot has also been written on the old ways, the old traditional ways, indicators, for example. When you read most books on trading, it's all about indicators, the moving average systems, this, that. So what happens to all this now?
No, I mean,
Now that yeah.
the indicators and all that are still useful. I mean, chart trading is still useful,
Mm-hmm.
right? There's no
Yeah,
way you're
yeah.
going to be able to see everything there, but you could look at the price action and you could kind of see where things are happening, right? The key thing is retail traders need to do is recognize the bullish zones and bearish zones and trade at those levels, not in between. And this is where retail people make a
Mm,
big mistake, right?
yes.
So some people are buying here, some people are selling between the zones, trying to get ahead of it. And don't do that. Recognize your zones,
Mm-hmm.
trade around here or trade here, right? Those are the best
Mm-hmm.
levels to trade and allow your money management to
Mm-hmm.
pretty much dictate things, right? And go from
Mm-hmm.
there.
Mm-hmm.
Does that make sense?
Mm-hmm. Yeah, totally makes sense. So that means retail traders, we really have to be patient. We really, really have to be patient, wait for price to just come at those zones and take action or make decisions based, on price coming at, those zones. So, sometimes we have FOMO though. We have fear of missing out. Sometimes we think we are
Yes.
missing out. That's why we want to jump in. We want to jump in between the zones. I mean, yeah, yeah.
I mean,
Okay, good.
the common
Mm-hmm,
errors retail people make, if you
mm-hmm.
categorize it, right, is trading
Yeah.
every breakout, right? Trading every breakout and not looking for confirmation. That's the biggest thing. Trading breakouts are fine, but you got to look for it to confirm. So if it breaks out and you're profitable, then you stay in the trade. If you're not profitable, you get out. But most people have that fear of missing out and this and that, and they live on hopium. No. If you enter a trade and at the end of the day you're not profitable in a breakout trade, why are you still in it? It just doesn't make sense at all. Get out and look for it. Minimize your losses, right? So, yes,
Yeah.
the biggest mistake retail people make is doing breakout trades. But to me, that's not the mistake. It's the money management perspective is the mistake. Breakout trades are fine. I still take them. But the key is at the
Mm-hmm.
end of that day, you have to be profitable. If I'm not profitable, what's the point of that breakout trade? It's not going to go, right? It's a fake breakout.
Yeah.
So get out with a minimum
Yeah.
loss and not live off hopium. Whereas some people are like, well, okay, you know what? I did a breakout trade here. It's still above my level. I'm going to stay in it. No, get out. And that's the biggest mistake there. Second is ignoring liquidity levels, right? Seeing liquidity levels, looking at the spreads, right? Looking at the spreads will give you a very good idea. If the spreads are huge, what's the point of you trading it? It doesn't make sense. There's something going on, right? Third is
Mm-hmm. Mm-hmm.
chasing momentum. I hear momentum over and over and over. Momentum doesn't really matter at the end of the day because you may have momentum, but the momentum's a retail perspective, right? Momentum's going up because the
Yeah.
retail people are driving it up now. So if this is going up with institutional momentum is correct, but if it's now going up with retail people, the momentum's wrong. So momentum could be fake if it's based on retail buying or selling, right? So people
Yeah,
chase
yeah.
momentum a lot, but they need to look at momentum of, is it at the beginning of a trend or is it at the end of a trend? Because if you look at momentum at the end of the trend and you're going with what the trend is, that's the retail momentum and it could die anytime. Okay. And then lastly,
Mhm.
the placing stops at previous orders. That's not good at all because institutions are looking at where those orders are. So you have to be very, very careful there. Does that make sense?
Yeah, makes sense. And there are some terminologies also institutions use. For example, when you look at a chart, an order block, fair value gap, and such things. These are the things that we're supposed to start familiarizing ourselves, with. In
Yep.
fact, I was telling you before we started, I was really looking into this research. I was doing a lot of research on institutional type of approach when it comes to trading, studying about order blocks, studying about fair value gaps. And the most interesting thing I discovered was you can basically have just that one strategy and say, hey, I'm just going to be looking at order blocks. That's it. That's it. Nothing else. For example, I'm just going to be trading fair value gaps only. That's it. But now for us, the challenge on the retail side sometimes is we want to trade everything. We want to trade the
Yeah.
order block. We want to trade the fair value gaps.
Yeah.
we, we, we tend to forget that at the end of the day, it's about making money. It's not really an intellectual exercise as well. It's, am I making money? It's not like, am I trading fair? I know fair value gap. I know order blocks. I know inducements. I know the traps. You can't do all that, guys. You cannot trade everything like that. You just have to be very disciplined. Pick one, which is you find it. For example, my favorite are the order blocks. That's my favorite when I'm looking at charts. During the day, during times when the trading session is really at its peak. During the London, maybe Asia overlap, New York, London overlap. During those periods of time, can I spot an order block? Can I spot if I'm someone who goes with fair value gaps, can you spot a fair value gap? Can you spot an order block during those peak hours? And if you're disciplined like that, then definitely you're going to make to be profitable. But if you're all over the
Yep.
place, yeah, you ain't gonna be profitable. So yeah, I think we have really talked much about things from an institutional perspective. Any last words you have
Yeah,
for
so we
us?
gotta wrap up, but so let's summarize in a
Yeah,
couple of bullet points, right? So from
yeah, yeah,
my
yeah.
closing remarks to people, retail traders especially, is trade, if you're trading currencies or any instrument, trade between the London and the New York zone. That's when you have the most liquidity. That's the when you have the highest probability of success. It also sets a lot of trends and stuff like that. Two, stop looking at volume. It's not going to help you and it's actually going to bias you the wrong way. Okay. And then three, recognize the key support resistance levels and trade around them. Don't trade in between. You have to become patient. Wait for price to get to those levels and then trade at the critical zones. And with your money manager, and you have a high probability of success. And then lastly, if you're doing breakout trades, it's great to take breakout trades. I take them all the time, but make sure your money management's there and you're profitable at the end of that bar. If not, get out. Don't sit there and live off
Yeah.
hopium. That's my closing remarks. How about you, Dennis?
Yeah, basically I'll say be understand the kind of momentum that you are chasing. Don't chase everything, as you said earlier. Understand the kind of momentum that you're chasing, and let's try not to catch falling knives as well. Trying to get in between these zones, trading in between the zones because we have FOMO, the fear of missing out. Just you know, let's understand that 80% of this business is really psychological, and institutions, the way they're looking at markets, they have a different psychology when it comes to their approach to the market. So let's try and adapt that kind of mentality or mindset in order for us, of course, to trade professionally and to trade in a way that makes sense. As you had said, the spread is so high. Why are you trading? Such things. Yeah, that's my take, Manesh.
Great. That's a great summary. Well, we took a hard
Yeah.
subject and simplified it.
Yeah, yeah. I really tried, yeah. Mhm.
Yeah, so
Okay, so
I think it's a wrap up for us.
mhm. Yeah,
Yeah, so
it's a wrap
thank
up
you,
for
Dennis, for
us.
joining. Hopefully Ryan will be better and be back as a host. I don't know how I did as a host today, but hey.
No, you try. You've done excellent, Manesh. You have done excellent. We have basically learned a lot, and yeah, you're a great host. You are a great host.
Oh, thank you. Well, stay tuned for
Yeah,
next week's topic. It should be an interesting one. The topics are getting more and more interesting now, week by week, aren't they?
yeah, yeah.
It's
They're
even
getting
getting
interesting,
challenging
and
for us.
yeah, and and the challenge makes it better. It makes it better. It makes
Yep.
us understand better. And Manesh, by the way, we it's such a blessing to have someone like you who is guiding us through all this, because you have had the opportunity to be on the other side, the institutional side.
Yeah,
So
thank you.
thank you so much. Yeah,
Well, trust
thank
me,
you.
I made a lot of mistakes as a retail trader. I mean, it's a lot of years of mistakes to get to this knowledge, trust me.
Manesh, when we want to become like you when we grow older.
I don't think so. Well,
When we
thank you
grow up, we
again
want
for
to be
everyone.
like you. Thank you. Thank you, everyone.
Thank you everyone
Have
for
a good one,
joining and
guys.
stay tuned for next week. Thank you.